market. And to quicken all your pulses, I'll tell you where IREDA closed, 112 rupees. It's a 250% appreciation over the last 10 sessions on what was a very muted kind of an IPO. I checked the data over the last 1 calendar year, and we have about 50 IPOs that have got listed, out of which just 5 are below par. So that's, ladies and gentlemen, the kind of bull market that we are facing in India these days. And it's a wonderful, wonderful panel here. For all those people who did not get an allotment in the IPO, you now know who to blame. Okay, we'll begin this discussion and we'll start with the lady. What a pleasure to have you again, Manisha. And let's just try and understand how structurally the IPO market has changed over the last 10 years or so. You've been watching this space over the last 2 decades. What has changed from the point of view of the issuer?
Thank you. Thanks for having me. I think if we just step back and see structurally, the Indian economy has changed a lot. You know, when Amit Tandon was sitting there and I started our careers, to do a 50 crore or 100 crore IPO used to be a challenge, right? There just wasn't depth in the market. You had to go to an LIC or some of the other large domestic institutions, couple of FIIs, and hope that at least 2 to 3 of them subscribe the deal, and then you bolt on the other investors. Today, we're a $5 trillion economy, market cap of $4 trillion, 5th largest in the world, very deep markets. So that has basically resulted in larger equity issuance, larger IPO issuance, and a greater appetite for equities. Then I think also what's changed a lot is the reforms that the regulators and the government has done, right? There's so much more transparency, corporate governance, proxy advisors are at your toes, you know, saying what are you doing. So I think all of that is excellent because it gives comfort to the global investors that this is a market that's serious about the business of business. And lastly, I think just what's happening domestically, there is so much inflow into the equity markets. You know, till my parents' generation, you had to invest in gold or real estate. As interest rates fell, as more of the professionals joined the formal economy, as real estate became less attractive, investors started to come into the equity markets, especially during COVID. There's about $2 billion of, we all know $2 billion of capital coming monthly into SIPs, $35 billion of domestic money that came in last year. So what that's done is that it's countered basically the foreign inflows. As I said to you before, when we started our careers, if one FII pulled out, you know, the 250% you mentioned would be the other way around. You know, it was literally as anemic as that. Today it doesn't matter because there is so much domestic resilience, there is so much domestic capital, and you know, I think Axis will tell you more about that than I will. That there's so much resilience that, you know, equities have become so much more attractive, and as people are going up the risk curve, they're coming more into the IPO market.
Okay, what we'll do is we'll touch upon Manisha as far as the other side of the equation is concerned, but to you, Salil, I just want to understand how thick is the pipeline as far as Axis Capital is concerned. Of course, over the last 43 IPOs that have come in over the calendar year, Salil has helped 9 get listed. So I presume that this year's bonus would be fantastic for investment bankers.
I wish the last part was true.
I'm sure it will be.
But no, I think pipeline is pretty strong for markets as a whole. I mean, for keeping Axis Capital aside, even after the flurry of IPOs that we are seeing right now, I think between IPOs which are filed with SEBI, which are approved and awaiting approval, we have between them another 65 IPOs in the pipeline as far as India is concerned. About half of them are with the SEBI approvals. This month itself, we are seeing 2 of them which has just opened. We do expect at least 3-4 more to happen before the end of the month itself. And more important than the numbers is just the quality of issuers that we see coming around. I think a point that Manisha mentioned about governance standards, about how the regulator has been proactive, has all ensured that the names that finally reach the marketplace are quality names. Governance standards are very high. Investors are extremely clear about what they want to invest in, what they don't want to invest in.
Absolutely.
That makes a big difference. For every IPO that happens, there are a couple of them which don't necessarily happen. The markets don't necessarily see that. That's because investors are selective. That's resulting also in correct pricing. And that's why 90% of the IPOs that have happened in the last, in this current calendar year are all above water and doing well. I think the what has also helped the pipeline per se is the sheer amount of domestic capital available around the place, which to my mind is only getting stronger by the day. Manisha talked about the 50 crore, 100 crore IPOs. Yeah, we all started our careers when the book buildings in India started with a 100 crore size, and today 100 crore is not a size.
And the largest issue that you managed was 4,300 crores for Mankind Pharma.
In the current year, and prior to that, the LICs and the Paytms have been 18,000, 20,000 crore issues.
Absolutely.
And they have got done properly with Indian investors putting that in. One last statistic which is very important is there's a lot of dependency on FII investors in India in the past. If you take the current statistics of all the institutional book, an institutional book is split between domestic and foreign. There was a time when almost 75% of the institutional book used to be foreign. And so if one foreign investor decides to go away, the book looked weak. This time, across all IPOs, 60% of the institutional book is domestic. And therefore, the resilience of the markets is very strong, and domestic flows are being really very strong. So all in all, great pipeline, more importantly, good quality pipeline, and underlyings are good, businesses are doing well. So we do expect that, this kind of comfort around the marketplace will remain sustained for a bit.
Okay. Let's look at the retail angle to this, and we have Dhiraj Relli with us. He's a part of HDFC Securities, probably the brokerage with the largest retail reach when it comes to IPO applications. Dhiraj, to you, what has changed over the last 12 to 18 months? Do you see more IPOs being applied to online? In fact, I tried applying an IPO about 2 weeks ago, and unbelievably the process has become so smooth. What has organically changed for providers such as you when it comes to applying for online IPOs, and what is the granular data telling you?
So, good afternoon, everyone. Thank you for having me here. I think the whole ecosystem has changed dramatically. It started with having more trust on the capital market ecosystem. That's the start point for retail participation, and that's where we see that there is a disproportionately higher comfort of investors, particularly retail investors, in the market ecosystem. They believe that it is quite robust. Then on top of it, I think technology have been a very big enabling point. Now you can do IPO with just one click.
Absolutely.
Okay. Most of the brokerage houses have an execution created in such a fashion that you just go and just with one click you can execute your IPO also. The third piece is that the awareness about the companies and their details through social media, through media players like you, I think that has also increased the participation. And right now the information arbitrage is very limited. Earlier the information arbitrage was very high. Institutional investors, whether it is FPI or domestic, were having an edge over information. But now through the social media platforms and brokerage houses or many other players, including media, the information is easily accessible to the retail investors. So it's not just the one piece. I think it's the whole ecosystem, the culmination of technology, regulatory framework, ease of doing investing, ease of doing business, the trust, all that has enabled a greater participation.
Right. So what we'll do, ladies and gentlemen, now, the young gentleman that you see seated 2 seats to my left is Pranav Haldea, and Prime Database, for all those of us who've been in the market for about 30 odd years, you would know that it's the pioneer when it comes to listing IPOs. Mr. Haldea, what a warm welcome to you. I just wanted to understand over the last decade or so, what has changed for service providers such as yours when it comes to getting IPOs listed? I distinctly remember about 2 decades ago, we used to source data from Prime Database when it came to forthcoming IPOs. At the moment, this data is very easily available on all websites. So how do you differentiate yourself now?
Well, I think, one biggest change from the 90s till now is just in terms of sheer numbers.
Absolutely.
So, you had years in the early 90s where you had upwards of 1,000 IPOs in a year. Now we feel very happy if there are about 50. But at that time, there were 1,000, 1,200, 1,500 IPOs in a year. And a commensurate number of intermediaries to handle those IPOs as well. So the number of merchant bankers that you have, the number of brokers that you have, is a tiny fraction of what you had in the 90s. So I think that's been one big change. Of course, even in terms of the quality of companies which Salil spoke about, at that time you had a lot of fly-by-night operators as well. In fact, one of the ongoing arguments which I keep on hearing about is, if an IPO is a OFS IPO, then investors should not invest.
Yes.
But if it's a fresh capital IPO, they must invest. I keep on remembering the times of the 90s when all the IPOs were actually just fresh capital.
Yes.
In fact, they were absolutely greenfield companies which did not even have a manufacturing plant. Everything was on paper. And yet, and you saw that a lot of these companies ran away with investors' money. So they were all fresh capital, but they made for terrible investment.
You're talking about the 93, 95 IPO bull run that we saw.
That's right. That's right. So I think that's one major change which has happened. Talking more recently, I think, one of the biggest changes that we've seen in this last 1 year has been in terms of the, broad basing of sectors. In 2023, the kind of companies that you've seen from manufacturing, I think even in the previous session, they were speaking about, the pickup of the manufacturing sector. So 2023, unlike the last 5-6 years wherein you've seen a lot of companies coming from BFSI, I think one big change in 23 has been, the rise of manufacturing sectors as, IPO companies. The other is also in terms of the size of the companies themselves.
Yes.
I think this year, the average issue size was about 900 crores, which is down from about 2,000 crores 2 years back, which is a very interesting data point because it kind of says that, slightly smaller companies, relatively smaller companies also now have the confidence to come to the market. And, since we are at a Wealth Creators Summit, I think, it ties on, very well with that.
Right. Manisha, this one comes to you. When you look at how regularly we've changed when it comes to managing the, the legal part of the IPO, as also the fact that it used to take anywhere between 3 to 4 months for the IPO to get listed in the bull run that you talk about. Now it's less than a week, and probably it's going to narrow down further. What are the other regulatory changes that you're looking forward to that will make this particular market more robust?
So, if you speak to any of the global investors today across geographies, they say India is one of the markets which is the highest on corporate governance, regulation, etc. And the settlement point that you made is going to be transformative because I think that was, as Salil will tell you, that was a real blocker for a lot of investors because they didn't want to block their capital. Forget retail investors, institutional investors didn't have the mandate to block their capital for that kind of period. So I think the fact that we're able to settle much faster is a big positive. I think the fact that SEBI's mandate, SEBI has huge strict rules on how the board should be constituted, women on board, regulations on ESG, climate change, etc. All of these things basically show that we are very serious about ensuring that the companies are very high on corporate governance. Then also, as you know, in the last 10, 12 years, we've had private equity come in. The point that Pranav made, why is it that a 900 crore IPO happens now and previously it was 2,000? One of the key reasons is that because a lot of these companies have had private equity investors in them and have got used to the quarter-on-quarter treadmill, right? I mean, when you get listed every quarter, the investor expects to hear something new, wants full disclosure, and these companies today are already prepared. So with the combination of government, regulation, and external investors, the companies are very different from what they were 15 years ago, where it was just the promoter, essentially. I mean, with one business plan, and those were the frothy markets. I don't think you can do that now. Firstly, your own investor base won't allow you to do that. And secondly, you're used to the level of governance that the market needs. So, I remember when we used to do IPOs earlier, it was such a challenge because you pretty much had to change the entire management team. Literally, the munshi of the promoter used to be the CFO and say, "Yes, CFO," and you're like, "No, this cannot be the CFO. This is a serious, there are some serious disclosures."
And promoters are now more amenable to those changes.
Correct. Yeah, absolutely, because they know that's the only way you can come to the IPO market. Accounting firms, all of that, everything, all of the the different pieces. So it's not just regulation, it's the fact that all the different pieces have come together, which make the company far more easily IPO ready than it was a while ago, where we would take literally a year to get a company IPO ready. It used to be a business, just restructuring, advising companies for about a year. It's not the case now because a lot of the work has been done. To be fair, a lot of the promoters have second generation children who've gone and studied internationally, who understand the importance of governance. There's a lot more exposure. And even today, domestic investors are demanding, a lot more disclosure. So I think a combination of all these things has resulted in the companies that are coming through across sectors, right? Earlier, I remember the companies that we all used to like and we all used to go running to pitch for were basically export-oriented companies like pharma, IT services, because we were like, these are the companies which naturally have high governance. So, we would all steer to those companies. No longer the case. Across manufacturing, renewables, traditional companies, new age, e-commerce, tech companies, you're seeing a lot of governance driving these companies. So I'm quite optimistic on our regulatory and governance standards, and all my global clients tell me the same, that we should be proud of what we've done, and the small time that we've done it, thanks to technology and the digital public stack that we've created. I think the kind of way that we have instilled these changes and brought in new investors into the market is a record.
Okay. Salil, this question comes to you. When you talk to promoters, and I'm talking about, say, a decade ago, the big ticket or the aspirational theme used to be to get listed on the NASDAQ or the NYSE. Somehow, that particular trend is now more or less dead. And the preference is, of course, Indian equities, and this theme of OFS. I speak to so many retailers, I speak to so many brokers, and they tell us that, there's a bit of a question mark when a 2,500 crore IPO has 2,300 crores as an OFS. It seems that, the retailer is being taken for a ride. What does the promoter at that point of time think? Pricing an internet company which, more or less sells automobiles on the net, being priced the way it is, and all of it being an OFS?
So first, let's take the myth out of the OFS being negative. Frankly, the OFS being a large component means that the company which is going to the market doesn't need the capital, and therefore it's not unnecessarily taking capital inside, which means that they've built a business out using either promoters' money or private equity money, built it, taken all the risks of building the business out, and once the business is well built, it's only when they're coming to the markets. So please, the market should look at it this way, that quality businesses, well built out, risk of building completely taken care of, and now it's ready for an IPO. There is a regulatory requirement that 10% needs to be diluted, and therefore a lot of companies have to do either a combination of fresh or a secondary. A lot of times the secondary comes into picture. Many a times this OFS is not only about the promoter selling. We do see a lot of private equity, who are the people who've taken the risk in building the business out, selling through the offer for sale route. And therefore money goes to private equity, which anyway has a limited amount of period, right? They're typically 5-year to 7-year funds, and they've taken the original risk, they're monetizing, they're returning back money to their LPs, and that money comes back into the markets because they fund newer businesses. So I actually think that the fact that built out businesses are hitting the markets is actually a big strong point.
Yes, and I think that's the dramatic change that has also happened over the last 2 decades. As Pranav was mentioning earlier, if you had an Excel sheet and you were able to get a DRHP done by SEBI, yes, you could sell that IPO and it would also get listed. But now it's the established companies, and perhaps your point on OFS is very well taken. Tata Technologies has done fantastically well. Yeah,
all of this. And the other thing about primary capital is, Pranav mentioned about people raising primary capital on a business plan and disappearing. Today, SEBI is very clear about the monitoring mechanism. For every 100 rupees that you raise, the clarity on what you want to put it to. The end users has to be clear. Merchant bankers like us have to validate it. None of us will take the risk of validating something which we cannot validate. So we will ensure that only something which is completely kosher is out there. So therefore, no point in raising general purpose capital wherein there's no end use. So that's good news for market. I will actually look at it from every investor's point of view, that the fact there's been a good quality set of private equity sitting inside means that there is a business plan which has got validated. There's a strong regulator which is ensuring that end use of money is monitored, means again that it can't be misused in any way. Then it comes down to business growth risks, which is what equity markets is all about, and that's perfectly fine to take.
Okay. Dhiraj, this one comes to you since you have probably the best known digital platform in India when it comes to the financial banking part. How much of these IPOs are now being applied for online from the tier 2, tier 3 cities? We sit in Bombay, and there was a point of time that 50 to 70% of the IPO used to be filled by investors in and around 200 kilometers of Bombay. Has it changed now?
Dramatically. I think we are getting more and more investors to participate from not only tier 2, tier 3, I think even tier 4, tier 5 cities also. So as I said earlier, the information, access to the information is easily available, and the risk appetite of the investors have also changed over a period of time. They have seen many cycles. In last 2.5 decades or so, there has been a dramatic change in their risk appetite. They understand that the fraction of their investment must go into the equity or equity-related products to make optimum return on the portfolios. So for the new investors, there is a fancy for IPOs. They think that this is their way to participate in the capital market, particularly in many family accounts. Like when you have 4 or 5 family members who are eligible to apply, they may not invest in secondary market in all 5 names, but when it comes to IPO, they think that this is the way they can participate, and that's where we see more inclusion when it comes to the number of unique investors participation in the capital market. So that is something which is driving the market. It used to be a phenomena in Gujarat particularly, or maybe Maharashtra, more dominated by these 2 states, but it is now well spread, and I think we are getting participation from such small pin codes and such small cities that it's difficult to fathom that how the information has reached to these places and how they are able to participate in the equity or IPOs.
I think you will have to thank the media for that. And
yes, absolutely.
We'll pat ourselves.
And technology as well.
Absolutely. Technology has been the game changer when it comes to the entire financial space, and all of us on the table will recollect time when the open outcry used to be in Bombay, and it used to be a great sight. But remember, everything was limited to Bombay when it came to retail as well as institutional participation. Pranav, we've talked in detail about the mainline IPOs, but it is the SME sector which is, the Wild West, so to say. This is the same theme that we discussed a bit earlier, the 93-95 bull run in the IPO market. Do you have any benchmarks or pain points when it comes to the boom that we are seeing in the SME IPO sector? Is it going to sort of continue for a while, or you see some kind of headroom being filled?
Well, so before I come to that question, I would just like to add on to what Dhiraj had said. I think somehow this impression about IPOs to give positive gains until perpetuity has been continuing from the times of CCI. So still, what he said in terms of a lot of new investors coming in through the IPO route, that continues till date. And, most retail investors continue to come in from a listing gain point of view. And you find very few investors really coming in from a long-term perspective. So I think, that is something which kind of needs to change. Even the data that you alluded to at the beginning in terms of the number of IPOs which hit and how many are trading above issue price. The point is that at what point in time do we say that, do we judge the issue price of IPOs? Is it 6 months down the line? Is it 12 months down the line? Is it 1 year, 5 years? Because the day a company gets listed, it becomes like any other secondary market stock. And the share price will go up and down on the basis of the company's performance, the sector's performance, the market's overall performance. So in my view, it's a bit unfair that we kind of expect IPOs to not just give positive returns on listing, but also until perpetuity, whatever that timeline be.
India is one of those countries where you hope to make money on a regular basis in the markets, and perhaps, that is where that sentiment comes
Yes.
from. Till about 2 decades ago, IPOs were, decently priced. This is not to say that investment bankers are to be blamed or, it's just the environment. The data that I give you, if we had this discussion about 10 months ago, it wouldn't be as rosy as it is today.
Exactly, exactly. So it is at what point in time do you look at the data, and on that basis we make a statement on how good the issue price was. Anyhow, to answer your question about SMEs, yes, of course, 23 has been a stellar year in terms of SME IPOs. I think over 4,000 crores has been listed. My view is that, and you've seen some, action from SEBI, the regulator, as well of
absolutely.
late. I think it's a bit of a mixed bag. There are, some high-quality companies that you're seeing coming to the, SME segment. You also find that a lot of institutional participation has come in. If you look at the anchor book of some of the SME IPOs, it includes some of the world's largest hedge funds as well. So I think it's a bit of a mixed bag. Retail investors especially should approach with extreme care.
Absolutely.
I think it's also time that the threshold of 1 lakh, which was set in about 11 years back when the segment came up, needs to be looked at purely just from an inflation point of view. I think the minimum threshold for retail investors must go up, and it's buyers beware. The liquidity is very less. The trading is also very low, so I think investors need to be very careful while dabbling in these.
Manisha, to you, any warning signs that you see from the SME sector? What should retailers, what should investors with, basic amount of money to deploy in IPOs should look at when they put in money in an SME IPO?
So I think pretty much the basics, like what we were taught in the kindergarten of finance. Look at the DRHP, look at the financials, look at the balance sheet. There must be a path to profitability at the very least if there isn't profitability. Ideally, if you're a retail investor, go for sectors which are well researched and not something which is, just a new idea, something in the Gen AI space, which you don't, because not for any other reason, but we don't understand that there isn't enough of a track record. So I think go look at sectors. Most companies, and Salil will tell you this, will come and settle in the same valuation range as the other companies in that range after the initial euphoria. Yes. So, try and go for sectors which are well researched. Please look at the balance sheet. Look at the bankers that are advising on the IPO, right? High quality, reputed bankers should be putting their name to it. The accounting
Someone like
firm,
Access Capital to your right.
Absolutely, that's fine. I don't do IPOs anymore, so happy to. Yeah. So I think that all of that is very important because, while I feel that a lot of the valuations are justified in the SME space, because what the investor is seeing is that this is a 5 trillion economy going into a 10 trillion economy, and what they're seeing is that these companies with a lot of efficiency are going to grow very rapidly, but at the same time, some do slip in, right? In a frothy market like this, as you said earlier, there are some companies that can tend to slip in, and it's really important that we either, invest through SIPs if we don't understand the market, be patient around companies, and if you're investing directly, invest in companies after thoroughly reading the balance sheet, looking at the board of directors, the management team being good. When these boxes are ticked, only then go in.
Right. So we have 1 minute, 50 seconds left, and now comes the most important question, which I'll ask all panelists, starting with you, Salil, because you've managed the maximum number of IPOs here. What is the magic bullet to get a confirmed allotment in the IPOs that are in the pipeline? I have the answer, I'll tell you last.
Just look around for the nearest temple. Siddhivinayak is not too far.
Okay. Visit a temple, a church, or a masjid. That's what Salil says. Ma'am.
My 85-year-old mom seems to get all the allocations, so I'll ask her and tell you because I haven't figured it out at all.
Okay. So since he's talked about mandirs, we'll also look at her astrological chart.
Yeah, our blessings from the parents.
Absolutely. Pranav, you've been listing IPOs since 1980s. I'm sure you have an answer.
Well, apply in every single relative's name that you know of.
Okay.
That's one way. But, seriously, with the kind of oversubscription that you find, the chances of allotment are low. And even if you get an allotment, you only get one lot. So it's, to move the needle, it doesn't really do anything. Absolutely. One lot of allotment.
So I presume the three of us, the three of you haven't been as lucky as you have been in getting business from IPOs, right? Do you apply?
You're not allowed to apply. So.
Acha, chaliye. Okay. Dhiraj, the last one comes to you.
I think investors should invest post IPO, immediately after the IPO. That's a better way, because if you look at some of the IPOs, how they have performed the post listing also, carrying on what Pranav mentioned also, you should look at which are the good businesses and stay invested in those businesses. I think that's very important.
They get listed at 80% premium, but we'll take your word for it. At least you have given
There
some
are
practical...
examples like Arida also, which is after 32 rupees, now it's almost at 100 rupees in 10 trading sessions.
112, I'll just put in the right number.
Salil
wants to add.
Look at the anchor books, because the anchor books reflect the quality of names that have validated it and feel comfortable about it. The best of insurance companies, the best of mutual funds, when they participate, you know that somebody's done a lot of homework. Even if you do not get, stock in the IPO itself, these are the companies wherein there will be follow-on buying post-listing. And that's also, there's a time for a lot of investors to also get more, skin in the game at that point of time. Plan for the long haul. As Pranav said, there is no point judging a company on an everyday pricing basis. Plan for the long haul, invest in a good business, stay put for a long period of time. Wealth will get created by compounding and not by a, selling trigger on day one.
Okay, so don't wait for the listing pop, buy it on the listing day. And my final two bits, if everything fails, please come to Delhi. There is a Bengali Baba who actually assures allotment in IPOs. So I'm going to meet him, do a story on that one. That will be on Business Today Television. Ladies and gentlemen, a very warm applause for our panel.
Thank you, Shail, for that scintillating session. A huge round of applause, please. And especially for that tip right at the end of the session.